Welcome to vTalkInsight, Market Drivers Daily for June 5th, 2026. An AI-led sell-off is colliding with a much stronger than expected U.S. jobs picture, and the rate path is being repriced in real time. Today we unpack how the cooling in AI enthusiasm, resilient growth, and shifting central bank expectations are reshaping risks and opportunities across global assets. AI remains the core macro and equity story, but the tone has changed markedly in the last few sessions. Earlier this week, we highlighted how exuberant valuations and a crowded AI IPO pipeline were meeting more demanding earnings scrutiny. Now that narrative is showing up in price action. Key AI and semiconductor names are under pressure, and U.S. equities look set for their first weekly decline since March as enthusiasm cools. The pullback is broad-based. Korea's Kospi, which had been a flagship AI barometer, has dropped close to 7% with over $10 billion of outflows, and European tech is off around 2% on the day with thin volumes. In the U.S., Nasdaq futures are lower. AI chip makers such as NVIDIA, Micron, and Broadcom are selling off after disappointing guidance, and an 8% weekly drop in the semiconductor index still leaves it more than 70% higher year-to-date. At the same time, around half of the Nasdaq 100 is trading above 30 times forward earnings, and surveys show many participants still assume any AI bubble ends gently, even as a vocal minority warns of sharper correction within weeks or months, especially around high-profile listings like SpaceX, OpenAI, and Anthropic. Against that cyclical volatility, the structural AI investment story is only getting bigger. One major forecast sees annual AI infrastructure spending reaching roughly $730 billion by the early next decade, and broader global AI capex is now expected to exceed $800 billion and potentially approach $1 trillion. Hyperscalers are aggressively raising capital, with individual funding rounds running into tens of billions, while firms like Meta and Google pivot from cash-rich, capital-light models to heavy, multi-year data center build-outs. NVIDIA has certified all three leading high-bandwidth memory suppliers, easing a key bottleneck but potentially squeezing availability for smaller players. And high margins for AI chipmakers are expected to persist well into the next decade if adoption continues on today's path. The AI boom is also transforming labor markets and policy debates. AI-related roles have surged to about 3% of job postings, an eightfold increase in a year, with roughly 200,000 openings that now rival the number of advertised nursing jobs. Firms that adopt AI report faster hiring and growth, while laggards face stagnation, and programmers are increasingly pulled into data architecture and network specialist roles. Yet estimates suggest automation could materially affect up to 120 million jobs across dozens of economies, especially in white-collar fields, feeding political pressure for guardrails, call for pauses in development, and proposals for government equity stakes or special taxes on leading AI firms. For markets, all of this means the AI theme is transitioning from a simple story about future potential into a more nuanced, execution-driven trade. Equity leadership is already rotating beyond the mega caps into memory, networking, industrials, and construction names that benefit from data center demand, even as overall breadth stays narrow. Key signposts now are the reception of upcoming AI IPOs, whether earnings and free cash flow can justify today's multiples, and how regulators choose to balance innovation with control. Those outcomes will also shape the growth backdrop, which is where we turn next. Behind the AI headlines, the macro data continue to describe an economy that looks more early cycle than late stage. Recent U.S. payroll prints have consistently beaten expectations, with May employment rising by roughly 170 to more than 270,000 versus consensus closer to 80,000. The three-month average has climbed to about 188,000, the strongest since early 2024, and unemployment is holding near the low 4% area, supporting estimates of around 2% real growth this year. Crucially, the gains are not confined to one niche. The latest jobs report shows hiring spread across leisure, hospitality, government, and healthcare, even if some categories like nursing are now seeing fewer new postings while retail gears up for the summer. On the corporate side, S&P 500 revenues grew more than 11% in the first quarter, with 7 of 11 sectors delivering double-digit top-line growth, pointing to broad-based demand beyond just the tech complex. Investment is the other powerful growth engine. U.S. equipment spending jumped about 3% in March, one of the strongest monthly increases on record, and non-residential construction is being boosted by intensive data center building linked to AI. Construction employment is rising sharply, helped by favorable expensing rules for factories, and is seen as a precursor to additional manufacturing jobs as facilities come online. We also see parallel stories in companies leveraged to defense and aerospace, where firms like Boeing are preparing to ramp jet production and suppliers report a step change in demand driven by drones and advanced equipment. AI and policy are amplifying this expansion. AI-related sectors are contributing a disproportionate share of S&P returns in economic activity, with one estimate expecting AI infrastructure capex alone to reach more than $700 billion annually by 2031. Companies across software, security, and infrastructure are raising guidance on the back of AI adoption, while some emerging names tied to data centers and industrial equipment report double-digit revenue and cash flow growth. At the sovereign level, reforms in fiscal support are lifting private investment in markets such as Egypt, with a private share of total investment has moved from the low 40s to the high 50s. The picture is not uniformly positive. Much of the acceleration is concentrated in AI, automation, and a handful of related sectors, while small businesses and lower-income households lag, and market breadth remains weak as only a minority of stocks beat the main index. Analyst projections for AI revenue growth, such as scenarios that take SpaceX's AI division from a few billion to several hundred billion of sales within just a few years, illustrate how aggressive assumptions have become. A downturn, wider credit spreads, or higher funding costs could quickly force companies to slow or defer large-scale data center projects, which would hit both headline growth and many of today's capex beneficiaries. That vulnerability leads directly into the debate over interest rates. The combination of resilient growth and firmer inflation has materially shifted the policy conversation. Markets have moved from debating how many rate cuts to expect toward whether the next move from the Federal Reserve might actually be a hike. After the latest payroll surprise, which beat consensus by roughly 80,000 or more with upward revisions, Treasury yields rose across the curve, with the 2-year moving into the low 4% teens and the 10-year climbing into the mid-4.5% area. Those rate moves are already feeding back into risk assets. A stronger-than-expected jobs report and rising yields have triggered a risk-off shift, with the S&P 500 down close to 1% and the Nasdaq 100 off about 2% in early trading, led by high-multiple tech and AI names. Tech just experienced its worst single session since April last year, and this week is on track to break a long streak of gains for U.S. equities, even though fundamental news from some AI beneficiaries remain solid. Inflation dynamics explain much of the hawkish repricing. Core PCE remains above the Fed's 2% target, and upcoming CPI data are expected to show headline inflation re-accelerating from around 3.8 to over 4% year-on-year. Some projections see service price pressures and supply chain frictions keeping inflation elevated into 2028, even if the Fed delivers 2 additional hikes in the second half of this year. In Europe, money markets are now pricing another European central bank hike by year-end, and a Bank of England survey showing UK firms planning to raise prices underscores that this is a global, not just U.S., issue. There is, however, an active debate about how far central banks should go. Some argue for staying on hold, noting that wage growth has eased from about 3.6 to 3.4%, and that not all of today's price pressures are demand-driven. Labor indicators are also mixed. Headline payrolls are strong, but small business hiring intentions are at multi-year lows, and current policy is hitting different parts of the economy unevenly, with large, cash-rich firms more insulated than leveraged households or smaller borrowers. In this view, over-tightening risks an unnecessary downturn just as supply-side forces like AI investment and reindustrialization are lifting potential output. For portfolios, the key is how a higher-for-longer rate backdrop interacts with growth. Elevated real yields and rising policy expectations are a headwind for long-duration, high-valuation assets, particularly in parts of the tech and AI complex, but they also make long-dated bonds more compelling for liability-driven investors, such as pensions and endowments. European fixed income stands out as relatively attractive where additional hikes are already largely priced, while in the U.S., expectations for at least 1/4 point hike by year and keep duration risk more finely balanced. Over the next few weeks, the May CPI and PPI prints, followed by a pivotal Fed meeting, are likely to be the main catalyst for volatility across rates and equities, and will help determine whether today's move toward renewed tightening becomes the dominant macro narrative. The big picture today is an AI theme moving into a more volatile, valuation-sensitive phase, a growth backdrop that still looks like expansion rather than slowdown, and a rate environment that is tilting from cuts toward a possible renewed tightening cycle. Watching how AI earnings, construction pipelines, and upcoming inflation data interact with this higher for longer rate narrative will be critical for cross-asset risk management and for understanding where leadership in equities and fixed income may rotate next. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.